Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 289 of the Independent Advisors Podcast, where Mark McEvely and I, Matt Jessup, bring you everything you need to know from the past week in the world of financial markets and financial planning. Mark is busy today with firm-related work responsibilities, so we are very blessed to have Director of Research and Trading, the one and only Nicholas Whitaker, on the episode. Welcome, Nick.
Always good to be here. Good to be here.
I'm excited.
Yes.
And as usual, for newer listeners, I don't know what content Nick has put together, so it's going to be fun to see what you have brought for our listeners and viewers this week. So before we dive into that, as always, let's quickly review the month-to-date and year-to-date performance of the major market indices that we track on the podcast, Nick. This data is from Y Charts, and it is as of the market close yesterday on February 26th. Nick, I'll let you discuss it.
Yep. So the S&P 500 is down 1.4% month to date, but up 1.3% year to date. The Dow Jones Industrial Average is down 2.5% month to date and up 2.1% year to date. The NASDAQ Composite is down 2.8% month to date and down 1.2% year to date. And the Vanguard FTSE All-World ex-US Index Fund is up 3.7% month to date and up 7.3% year to date. Checking in on the Treasury markets, the 3-month Treasury rate is sitting at 4.3, the 2-year Treasury at 4.0, and the 10-year Treasury rate is sitting at 4.25. So, in summary, little bit of weakness month to date. Still net positive on the main benchmark being the S&P 500. The NASDAQ is a tick lower. And interestingly, a little bit of a bid in international thus far year to date, which I'm actually going to talk about a little bit later. So we'll dive into that.
Interesting. You know, I think my initial reaction when you say that is I think people are trying to seek out what they feel is, you know, perceived value. I also feel the dollar has weakened over the past couple of weeks, which might have helped that international trade a little bit. And I definitely got some hot off the press research from last night in a minute here that I think you're going to find very eye-opening.
Interesting. Well, I'm excited to dig into that.
Yep, it's going to be good.
So jumping into big headlines and current events. So last Friday, today's the 27th, last Friday, which was the 21st, the market declined a bit. You know, we had a bit of a pullback. Just on, there were some inflation prints that the market didn't love to see, where the inflation came in hotter than expected. You know, it's still kind of hovering around the same kind of range there. So I would say the decline was really on that inflation, kind of growth, valuation worries, just with kind of like the market taking a pause. So you saw the major indices decline somewhere between 1.7 and 2.9. So that's where a big bulk of that kind of month-to-date performance is coming from.
Good to know. Worst single day of the trading year so far.
Yep. And other news.
Before you go on, I got a piece on this here in a second.
Okay, cool.
It lines up perfectly, and it kind of forecasts over the next, say, 6 to 9 months where that year-over-year inflation rate might end up. And then you and I can have a round table, and I think it might be very enlightening.
Okay. Yep. Yeah, that'll definitely help listeners and kind of digest
give them perspective.
So, in other news, Apple announced plans to spend and invest more than $500 billion in the U.S. over the next 4 years. Another component that's helping to boost sentiment in the news with just general sentiment in the market is the House passed its resolution for a larger reconciliation bill, which calls for $4.5 trillion in tax cuts and $2 trillion reduction spending over the next decade. So it's off to the the Senate now for consideration. So we'll see where that goes and where that ends up. But you know, the market likes to see that. There's been a lot of talk in the media about that. So
I think it'll pass.
Yeah, and I think the market's really waiting for kind of that, and then some more clarity on the tax situation. And so I think, you know, with all the tariff talk and then inflation and the market was ready to kind of take some profits or just pause.
Great excuse, right?
Right. Yeah. So it makes a lot of sense. Just another note on inflation, the PCE index, which is the Fed's preferred measure of inflation, will be released on Friday. So you could see some volatility on Friday, particularly if that print comes in a bit hotter than expected.
And those prints usually come in at 8:30 a.m.
Mm-hmm. Yep, in the morning.
EST.
Yep. And lastly, NVIDIA reported earnings last night after the close.
Yep.
The earnings were very, very good, received well thus far.
Yep.
The stock's up 1.9% in the pre-market hours right now.
Yeah,
so.
current time is 9:13 a.m. on February 27th.
Yeah.
My quick comment there is for those that have been watching the news over the past 5-6 weeks, general financial news and or our podcast on a weekly basis, we highlighted the market concerns regarding DeepSeek and was the AI spending boom slowing down in any way, and the market was kind of pausing for some time leading into these NVIDIA earnings, which is why they were, in our opinion, so significant. And the market was hoping that they would not only beat, but more importantly, guide. In a strong way. And though I have not personally dove through all of it yet, the headlines I'm seeing indicate that is, in fact, what occurred.
Yeah, the headlines are all good. Beat on the top and bottom. The guide looks in line and a little higher. So
yeah, I think
all's well.
That's definitely not bearish. Mm-hmm. And my initial response to this is, even if the market reaction is muted, over the next couple of trading days, that bodes well for a potential melt up into the end of the quarter, in my personal opinion.
Yeah, I would agree. So let's see. Do you want to take us off into tweets, articles, and research this week?
I do. I'm gonna start hot,
Okay.
just right out of the gate. So
no pun intended on inflation, by the way.
No pun intended on this one, but there'll be some other deliberate puns as this podcast goes on. So this is a piece I saw last night from, it's not true. I saw this at 4 a.m., so don't judge me.
Okay.
Macro charts. I follow this trader on X, has about 175,000 followers, always has some pretty good content. This was posted this morning at 3:26 a.m. And what it shows is the AAII index, which is the American Individual Investors kind of sentiment index. It's where you get a good sentiment indicator, and you can only answer one of three ways. You're either bullish, bearish, or neutral. There's only one potential answer out of those three. And so Macro Charts, he posted this data set, Nick, goes all the way back to the mid-'80s. Okay? It's quite a data set. And what's happening right now is bearish sentiment is hit just yesterday, number 7 for the most bearish sentiment going back to the mid-'80s. I want you to take that in for a second. There have been a lot of scary times, Nick, between the last, several decades here, okay? GFC, the tech bubble, global pandemics. I mean, there's so much scary stuff that has happened.
Bigger, scarier things than whatever is happening in the world right now.
And bearish sentiment is number 7 high of all time.
Yeah.
That the data set goes back to the mid-'80s. So I'm going to give you the 1 through 6 to give you further perspective. The worst, March of 2009, managed money through that time period. That was the very bottom of the GFC. Next was the beginning of 1990. War in the Middle East. Another point in 1990. Number 4, 2022. We only had raging inflation in 2022. 2008, that was the midpoint of the global financial crisis. And then number 6 was the bottom of the bear market in 2022 in September. And then number 7 of all time is yesterday. So here is my point. This is significant in my opinion. When you look at this chart, what is done is at these peak points of bearishness, what do you notice when you look at this chart? It all coincides with what?
I'm actually gonna reveal my hand and say I actually don't see this on the chart.
Oh, you don't?
On the chart. No, I think
It's such a hot late
an old version.
It's such a hot late addition into the podcast.
Yeah, because I must have just not synced on my version or something. So this whole time I'm really listening.
I love this.
Yeah.
All right, so
sorry about that.
go to your teams. I appreciate the honesty. Go to your teams. Click on the chart. So what you're going to see here is it goes back to the mid 80s in this bearish sentiment, and you're going to see the other 6 times these points of peak bearishness marked short-term bottoms in the market. In fact, Nick, you're going to see very quickly that in each of these instances, the market had already sold off drastically and was in a bear market in these instances.
Yeah.
The definition of a bear market is it sold off at least 20% from its high. And then all of a sudden you look at where we're at right now, and you ready for this? We're 3% off the all-time highs.
Yeah, it is. The tweet here says absolutely unprecedented. And yeah, that's...
Proper usage of the word unprecedented.
Yeah,
Got to give macro charts credit on that. It's usually abused in the financial news media.
It is. Yeah. Interesting.
So 3% off the highs. Number 7, all-time bearishness, sentiment indicator. That to me is a definite contrarian piece of data. And it's big in my opinion.
Yeah, it's interesting. It's interesting.
And of course, Jenna will put this chart up for our YouTube viewers. When I was talking about that, she probably already had done that. And it'll be in our show notes and all of our social media sites.
It doesn't surprise me that negative sentiment is up. I actually read a bit about that earlier this week. And I think a lot of that gets down to more the social aspect and the run that the market's been on recently with valuations among the big tech names and kind of some of the concentration in the S&P 500. So I think it's kind of probably all of that mixed in. And then participants of the survey maybe perhaps allowing some of their own personal negativities to impact their view. That would be my view from the cheap seats, I suppose.
I like that viewpoint, and see how I extrapolate this is usually people's sentiment are reflected in their portfolio allocations. So if you tend to see bearish sentiment this high, it means to me that people are postured within their portfolios underweight risk. That would be how you would correlate that through the lens of history. And in my opinion, you could see some people, if I'm right in my sentiment here and my thoughts, you could see people in the spring, if you start to see a recovery over the next month or two, say in the worst performing sector year to date, tech, you could see people chase some things going into spring.
Could have a bit of a buy the dip.
I think it's likely in my opinion, right? Not guaranteed, my 2 cents on the topic.
Yeah. I like that.
Pretty good chart, huh?
Very good. Yeah.
Hot off the press.
Very hot off the press.
Can you still say that?
I think so.
Okay.
That was posted at 3:26 a.m. this morning.
This morning. Hey, got to listen to the Independent Advisors podcast for all the hot news.
Yeah.
Hot news.
We're on it.
So my next piece is related to inflation, as you were indicating at the top of the podcast.
This is the
segue, right?
This is the pun I was talking about earlier.
This is awesome. Yeah. This is from the Kobesi letter, and this was from February 23rd. This is what the post was on X from the Kobesi letter. It says, shocking stat of the day. U.S. CPI inflation is on track to hit 4.6% annualized over the next 6 months, according to Bank of America. CPI inflation has averaged plus 0.4%, that's 40 basis points, on a month-over-month basis for the last 3 straight months. If this trend continues, this puts the year-over-year inflation on pace to hit 4.6% annualized by July. That'd be the highest since April of 2023. That would be more than double the Fed's 2% inflation target Even if monthly inflation prints ease to 0.3%, 30 basis points, year-over-year inflation would still rise to 3.8%. The Kobasi later ends the tweet with, inflation is accelerating. Jenna will put up this chart for our YouTube viewers. This will be in our show notes, Nick. What you're going to see here is the extrapolation that Bank of America has done, showing that if over the next 6 months, month-over-month inflation, if it averages 0.1%, if it averages 0.2%, if it averages 0.3%, and lastly, if it averages 0.4%. Even in a 0.2% in 6 months average, you'd be at 3%, which is about kind of where we're at now, okay? And 2.2% if it averaged just 0.1%. So what am I getting at here? And why did the market react the way it did last Friday? It pretty much was told by this inflation data, don't expect the Fed to cut interest rates anytime soon.
Yeah, absolutely.
And this takes me back to comments I was making on the podcast early last fall, and it bears repeating for our newer listeners. When you look at the lens of history, the slower the pace of interest rate cuts, the better it is for returns of risk assets. I'm not saying it's going to be an easy peasy ride from point A to point B. There's going to be volatility. And I think where the market is shocked right now is it seemed pretty easy through the middle of December last year, right? You had crypto going crazy. You could throw a dart on a board, pick a crypto asset, and you were making money. You felt like you could do the same thing with stocks. Then all of a sudden you go through a tough time period for a couple of months and everyone's crying like it's a horrible environment. It's just interesting how quick risk sentiment changes in these marketplaces. And to me, the fact that the Fed is not going to cut rates, boo-hoo, it's not a bad thing.
Yeah, I agree. Yeah.
That's my rant of the day.
I support the rant. I actually love it. Matt's fired up this morning. No, it's a great. They're great points. I think the market does get very boo-hooey around rates, which is why you see some of the volatility. And I have kind of a hot take on the Fed in general, where I don't think they've done that bad of a job when you look at it.
I agree. I don't think it's a hot take, but for some people,
in the market, it's a hot take. They think, the Fed's missed it at every turn and they've made things so much worse. And in the grand scheme of things, I think at times QE is, you can go into arguments on that. But in general, I think they've done a pretty good job. And I think they'll continue to do that. And what that means is they have to monitor this and be data dependent as they've always been.
Yeah, I mean, I think they've thread the needle. They've walked this fine line and thread the needle as best as they could the last couple of years. And in hindsight, no one thought they would have accomplished what they've done. Right. And I just think it's interesting in the marketplace. I think the worst case scenario that people are fearing right now, and I think the reason sentiment is as bearish as it is, and I'll tie all this together, is people are just concerned that as the year goes on, there could be a threat of a recession later in the year if tariffs, if this deficit cuts by the government are so severe. Of course, is that a possibility? Yes. Is it always a possibility of a recession? Yes. But based upon the data right now, things, in my opinion, are not truly reflective in asset prices. My 2 cents. Could things get worse? Of course, they always could.
Always could get worse. That's the black swan event could always happen.
Absolutely.
Right? Yeah, so.
My next piece is just kind of a warning sign about a recession. Look, I'm just playing into this perfectly. So this is a piece from Bespoke Investment Group, Nick, on February 23rd. And what it shows is housing starts going back to 1970. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. And lo and behold, when you tend to have a move down in housing starts, it could be a precursor, not always, could be a precursor to a pending recession, okay? So that's something that as the year goes on, I think should be monitored. Before I go to my next item, anything you'd like to say?
Just reemphasize could. That's not a guarantee.
Correct.
And then on the recession talk, remember, a while ago, and I'm going to get the timeline not exactly right, but when there was all the arguments of like, did we enter a technical recession? You know,
we did a couple years ago.
Right, a couple years ago. But there was like the argument of like, was it ever a recession?
It was
like,
definitely in a recession.
Exactly. And it's like not listed on this chart. So
Great point.
So like there's...
Great point,
and
Nick.
So and the reason I bring that up is because when people hear the word recession, they instantly go to like 2008.
Oh, that's another good point.
And so I'm like, yeah, we could have another recession, but like what if it's a little technical recession like we had a couple years ago?
Yeah, in the first half of 2022.
Right.
And so it's interesting you say that because there's so many market participants, either professional money managers or individual investors, that have that recency bias. That you hear recession, you automatically think the absolute worst case scenario of 07 to 09.
Yeah.
Right?
We are paid to think in those terms in a lot of ways. You got to think of the best, the worst, and then guide through the middle. So,
Yeah, I think that's a good way of saying it.
yeah.
It's interesting you say it that way. Yeah, I think there's that recency bias, in my opinion.
Yeah.
All right, my next piece has to do with home insurance non-renewal rates by all the counties across the country. I saw this post by a gentleman by the name of Lance Lampert. He is the Residential Club co-founder, editor-in-chief. I saw this post on X on February 22nd. Jenna can put up this chart for our YouTube viewers. This will be in our show notes. This is literally a chart, Nick, of the percentage of homeowners who just had their home insurance not renewed and canceled by the insurer. Now, I know we talked a lot in the podcast over the past year about the cost of home insurance, especially near coastal areas, going up so significantly. And we have talked about, I think it's like north of 20% of Florida homeowners don't carry home insurance now because either A, they can't afford it, or B, they can't get it.
Yeah.
Well, what you're seeing here in this chart, excuse me, is illustrative of the percentage in the areas where people are not getting the ability to get their insurance renewed by their current carrier. And I was surprised in some areas and not surprised in others. For example, was I surprised at what the chart looked like for Florida? No. We've been seeing this trend. I was a little surprised about the Carolinas.
Yeah. Yeah.
And, I'm talking to someone who grew up in the Carolinas right in front of me, right? And so when you see this chart of, look at the difference between North and South Carolina, that was surprising to me, seeing that the non-renewal rates for North Carolina were a lot worse. What's your thoughts when you see this data?
And I'd have to study historical storms because I obviously, like you said, I have bias. I have family in North Carolina. So when I see hurricanes on the East Coast, obviously I'm focused more on North Carolina, right?
Sure.
But I do think that North Carolina has been hit with hurricanes on an increasingly consistent basis in the past, let's say 5 years, relative to the first 20 years, 30 years of the 2020s.
Yep.
And I think that could be impacting that relative to South Carolina.
Interesting.
Right? And again, I could be biased. South Carolina could be getting hit just as bad, but in my head, I don't think so.
Interesting. I just want to see what your thoughts were on this.
Because I know the coastal areas of North Carolina are very flood prone because it's very flat, of course,
Sure.
coastal. And like my brother lives in Wilmington, for example. Actually, he lived in downtown Wilmington, and when they get a tropical storm, I mean, flooding is very real.
Normal, expected.
Yeah, very normal. It's expected. You can shut down streets, and I mean, for weeks, kind of thing. So, a bad rainfall can adversely impact the area, and pretty much the whole coast of North Carolina is like that. I mean, the Outer Banks, for example.
Interesting.
I'm pretty sure environmental economists expect the Outer Banks to just disappear someday.
Yes. Might not be soon, but at some point.
Yeah, so that'd be my guess on the Carolinas. But
Pretty interesting data. The other piece that shocked me was Northern California. I mean, I know that they've had their string of natural disasters, say over the last
earthquakes.
but
near
look at
fault
the
line.
just man, like north and in East California. Wow, it just surprised me. Just want to throw it out there. I mean, these are other kind of things that are happening.
You know what's the most interesting to me on this entire chart is whatever county is up there in is that Wyoming?
What's going on there?
What is going on there? Is it like Jackson Hole or something? Or,
Probably. I bet you it is.
Yeah. And then the other thing that's interesting to me is why just the one pocket of Tornado Alley
in Oklahoma, in West Oklahoma,
in the bottom part of Oklahoma.
Pretty crazy, huh?
I wonder if there's water there. If there's a river that's
I don't know. It's kind of also very interesting.
I
Right?
spend a lot of time diving into this.
See, isn't it crazy? It's just crazy when you look at that data. So I'm going to leave my part of this mix before I turn it over to you to a very thought-provoking headline that I saw. So this is a reminder of what I call continued innovation. This is an X post by John Ehrlichman. He is an independent financial journalist on X, February 13th. Jenna will put up this cover of Forbes now on the YouTube video. This will be in our show notes.
It's coming back.
In 2007, Nokia sold more than 300 times as many phones as Apple. And the cover of Forbes said, Nokia, 1 billion customers. Can anyone catch up to the cell phone king?
And
that was in 2007.
And what I'm saying is it's coming back is this guy's on a flip phone.
This guy is on a flip phone.
It's the return of the flip phone.
I just find it interesting that anytime you think that, something is impenetrable and it's on top and it's never going to look different. I know over the years of the podcast, we talked about the change over the decades of the top 10 stocks by market capitalization. It's just interesting. It's just a nice little reminder. You think anything's bulletproof, you still need to keep an eye on it.
Yeah, of course, always. If anything, I think that's when you need to keep the closest eye on it is when something looks bulletproof, particularly in a market environment where some of the big players are such a big part of the global GDP.
Yeah, that's a good way of saying it. Yeah.
And
I love when the market's climbing that wall of worry.
Yeah.
Yep.
Yeah. Absolutely.
Over to you, Nick. What do you got this week?
Alrighty. The first thing I have is just a quick kind of FYI, and this should make sense with the pricing that we discussed at the beginning of the podcast, where I mentioned the X ETF, the ex-US ETF was up 7% or some about 7% year to date. So we're seeing some capital inflows into Europe. What does that mean? Money, the flow of money is moving into Europe a little bit. This is an article from 2/20, so it's about a week old, from Bloomberg, and I'm just going to read a little excerpt. European equities attracted the biggest inflows since the war in Ukraine began 3 years ago, according to a note from Bank of America, underpinned by once strong optimism around peace negotiations. About $4 billion flowed into regional funds. So regional ETF funds is how this is being tracked.
Okay.
Basically, the way this is tracked, just side note, is looking at how the AUM on ETF funds moves, basically.
Yep, exchange-traded funds that are kind of the niche of these different countries within Europe.
Right. Yeah. So about $4 billion flowed into regional funds in the week through February 19th, the most since February 2022.
That's big. I mean, our markets are drastically bigger than theirs. That's a pretty big inflow.
Yeah, it's notable.
Yeah.
BOFA strategist Michael Hartnett reiterated a preference for global stocks to U.S. peers, saying markets such as Germany, China, Japan, South Korea are more attractive at a time when business activity is improving. Meanwhile, he warned that American markets face risk from an unexpected slowdown in economic growth. So one of the reasons I brought this up is because, A, it's interesting, and the price action is telling us that it's interesting. And, when we're talking about kind of what's happening last Friday with the market kind of pulling back with the hot CPI inflation and now recession, talks are bubbling and all of this kind of thing. And it goes back to the exact point that you made earlier when you were getting amped up when you were what did we call that?
I was on my rant.
That was it. You said it was a rant. I think of it as like a soapbox. But anyway, when you were on your rant, that was kind of one of the points you were making, where it's the market's kind of getting ahead of itself, and it's looking for value.
Yep.
In other areas, and so that's why you're seeing that those flows move into Europe. Is, in my opinion, is the market's looking for value because of some of the fears, whether those fears are necessary or not. That's kind of what's going on there. So what are your thoughts?
My thoughts is they're going to go a quarter or two, and all of a sudden they're going to realize the growth rates in those European equities are not keeping up with the growth rates of America. And, America, using the car analogy, going to blow right past them from a growth rate standpoint. Yeah. And, though you might have some people trying to pick up some values, there's a difference between picking up a cheap stock. If Mark were here, he'd say it might be cheap for a reason.
Yeah. There's a lot of that.
And I think that you really got to watch these growth rates. And anytime I see, fears of a recession surface, it's going to create opportunities in the market. Mm-hmm. And if a recession doesn't come to fruition in a short time period, boom, buying opportunity. And so we'll see kind of how this plays out over the next quarter or two. But it wouldn't surprise me to see the economy continue to be resilient and money flow back into U.S. equities because the growth rates are more. My final comment is, at some point, a recession will happen. I guarantee it. And I never say that term on the podcast. At some point, we will have another recession. Is that in 6 months? Is that in X amount of years? We don't know, which is why we watch the data.
Yeah, that's one thing we can guarantee, is that at some point in the future, there will be a recession.
Everyone always jokes, what's the two certainties in life? Death and taxes. Yeah. Jeez, I can add a lot more to that list, okay? And number 3 is a recession will happen again.
Recession, market fear, and market exuberance.
The two guiding emotions in investing, fear and greed. I can keep going, Jenna.
So continuing on the path of kind of market growth and expectations, a note from, this is briefing.com research. They have a research piece that they call the big picture that they update, I'd say monthly, maybe a couple times a month. This was updated on 2/21.
Okay.
And it's about 2025 earnings expectations.
Yep.
And the line that I pulled from this is as follows: fourth quarter earnings results have been much better than expected, as discussed last week. Yet the first quarter of earnings growth estimate has been slashed to 7.6 from 11.6 on December 31, according to FactSet, while the calendar year 2025 growth estimate has been trimmed to 12.1 from 13.3 on December 31. It is a trend. It's a trend in the wrong direction, particularly for a market sporting a premium earnings multiple. Just a side note for listeners, that right now we're about 75% through market earnings, so we still have about 25% of the market to report. So we're through a lot of the big hitters, Nvidia today.
Yeah,
particularly.
My initial reaction seeing this is to me is not overly bearish. I like that you're pointing this out, because I think that this is one of those headlines that is providing justification for the sell-off, especially within tech. Exactly. You have concerns about these growth rates in the market. But again, I think it's one of those factors. You really take a step back and you look at the consistency of earnings in, say, U.S. stocks compared to global stocks. You look at the growth rate within itself and compare it to places outside the U.S. That's very quickly why U.S. stocks trade at a premium valuation to their foreign counterparts. Yeah. I'll be curious as the next couple of quarters go on and you get through some of the concerns and uncertainties regarding tariffs and how that's affecting the status of the American consumer. I'm curious how this kind of settles and the dust settles on all these topics.
Yeah, and once we can really complete the tax picture in conjunction with the tariffs, I think that's another thing the market's waiting for.
Sure.
The one of the reasons that I bring this up is to just provide a little context of, okay, what do they mean by growth slowing and a recession, and we mean 13.3 growth to 12.1 growth. It's like 12.1 is still pretty good.
It's double digits, baby.
It's still pretty good.
Okay. And we got to keep in mind, too,
what I mean.
we are talking about a lot of these companies having market caps that are literally in the hundreds of billions of dollars. Yeah. This is not a small or mid-cap startup that is able to scale.
Yeah.
These are large companies that are growing double digits.
Yeah, they're it's incredible.
It is incredible when you really step back and think about it.
I didn't necessarily mean for all this to be themed, but with your points and mine, this has turned into
are we just becoming, I know we're already great. We could be becoming like best friends in the podcast here, Nick.
Are we best friends?
Are we best friends?
Then my next piece is on the equal weight S&P 500 price movement, kind of in conjunction with valuations. Mm-hmm. So this is an ex post actually yesterday from Coiled Spring Capital.
Okay.
And he says the following: equal weight S&P 500 is cheap at 17.6 times earnings, so 17.6x. So that's the PE multiple.
Yeah, the valuation.
So historic valuation around 20 is the market average. So when you hear premium valuation, you're thinking, and that's very simple. We could go into that, but just
because the last stat I saw is the top 10 names of the S&P 500 by market cap now make up about 39 to 40% of the overall size of the index.
Exactly.
Whereas if you look at the equal weight, if you take all 500 names and you equally weight them, right, then that is how you kind of get this.
Yeah,
right.
At 17.6, and
that's interesting because what it says is there's some cheaper valuation trading stocks and those smaller market cap names, and whether it's justified or not, we kind of made that comment. Just because it's cheap doesn't mean you should buy it.
Yeah,
but I think this is a very interesting observation, and I'm going to tell you why, in my opinion. Am I cutting you off by any chance?
No, go on.
So why this is very interesting to me is it's no secret that the popularity of indexing over the past decade especially is huge, right? Hey, I just own the S&P 500. I own the NASDAQ 100, right? These investment themes, I've been in the financial services industry now for over 25 years. I've seen different investing trends come in and out and back into favor. At some point, indexing is not going to be as easy, especially when you start to see 10 names make up 40% of the index. And at some point, you're going to see more of an equal weight. And it will be just a period of time. It'll be a cycle that will outperform the traditional indexing that you're seeing. Is that process going to start now? Did it already start? Or is this a head fake and it's going to start in a couple of years? You and I don't know that.
No one does.
But when it does happen, either you're going to see a lot of people who were just assuming, well, traditional indexing and say S&P 500 is always going to work. That investment type of thought process will go in and out of favor.
Right.
And I just don't know for how long. But when you start to see some data like this, you got to perk up a little bit.
Absolutely, and that's what we do. That's what you're the people who work in the markets. That's what we do.
Yeah.
So this guy says, and people talk about the stock market. Oh, it's so expensive. Valuations. He says the stock market is expensive on the surface, but that's because of the Mag 7. Strip out the Mag 7 and things are reasonable. So next time someone tells you stocks are expensive, you can share this with them. The average stock is simply not.
All right, so
which is an interesting point.
I got a really hot take on this, okay? And I don't know if this is going to be popular, okay?
I'm always here for a hot take.
This is a hot take.
I love a hot take.
Okay. Last 5 years, we've had a dramatic amount of inflation. They've printed a lot of money.
Yeah.
The value of the dollar is down drastically in the last 5 years. Okay. All things equal, it's no surprise to me that risk assets are up dramatically because of that inflation. Look at real estate. Most people can understand that aspect, okay? that home you probably owned, let's say it was $100,000 in value 5 years ago, I'd argue today it's probably 140 to 150. I'd throw that out there. Maybe more, right?
Maybe more.
So take a share of XYZ stock that makes COGS that is growing at 6% a year, that was at $100 a share 5 years ago. All things equal, because of the devaluation of the dollar and how much money they printed, it's no secret why, in my opinion, that the stocks are at the valuation they are.
Yeah.
So, I mean, I just don't think people talk about that enough. You see all these comparisons of valuations to history, overlay it with inflation, then talk to me.
Yeah. No, I agree.
That's my second rant of the day.
No, I love it. Yeah, it's a good point, because and that's one of the reasons I bring this up, is because there's so many concerns about valuations, but it's all relative, and there's reasons for that. And at the end of the day, do valuations matter? Of course they matter to some degree. But there's a great quote in the market that says, and I'm gonna butcher it, but the market can remain out of whack essentially longer than you can remain solvent, right?
Yeah, the market can remain irrational longer than you can remain solvent.
Yeah. Okay, so
you can't fight those trends.
Yeah, so I wouldn't get too hung up on that, but that's just food for thought on, like you said, the equal weight, and thinking about some of the concentration in the market, and thinking about valuations in general. It's like not everything is overvalued, and the things that are overvalued, to your point, should be overvalued.
They might be. I mean, I just think it's something
because they're growing at a rate that the market is clearly saying,
getting rewarded for it.
That's where we want to be.
I just think just to slap the traditional view that, hey, I'm going to look at stuff just through the lens of a PE ratio, I think you need to add more to the picture. Yes, it's an important data point. I'm not trying to water it down. But I am seeing people simplistically use that as a investment decision making still, and I feel that's a mistake.
This might be a hot take, but I actually don't think it's that important. I don't think PE is
I don't
that
think
important.
it's a hot, but it is for some people.
It is for some people.
It needs to be a data point. It needs to be a data point.
I think it's used a lot in the media, which is why it shows up here and when we talk about it, to try to help people understand. When the media is going crazy about, these valuations are just out of control and the whole market is overvalued. No, and overvalued is all relative, because the growth name that's growing at, like you said, 6 times earnings is going to be overvalued for a reason. Or I shouldn't say overvalued, a premium valuation for a reason. It makes sense. So you'll have pockets where the premium valuation spaces underperform or pull back or take profits because people have made a killing on it.
That's right. And there's always a healthy rotation in the market.
Yeah. And then the premium valuation names return.
And going back to what you said a couple minutes ago, the growth rate this year went from 13.3 to 12.3. Oh.
Yeah. And if the S&P 500, hypothetically, of that 12.1 or 12.3, whatever number it was, let's call it 12%, if the premium valuations make up 85% of that growth, what are you going to buy?
Yeah.
To find the growth. So that's where it gets down to, I think. Yeah. More so than anything. And we talk about that at length on the podcast for listeners, is it gets down to, in my opinion, the actual earnings growth.
I've said that for literally for decades. I think the number one indicator of a stock for me is its underlying growth rate.
Yeah.
And this is like the concern I have for 2026 is you might have just the numbers this year artificially helped. If you have a lower corporate tax rate and you have a lower regulatory environment, a lot of that will flow to the bottom line, and it's going to inflate earnings. And the problem is that's baked in after 1 year. And then Wall Street's all about, Nick, what'd you do for me in the second quarter of this year versus the second quarter of next year? Yeah. And if you no longer have that advantage, that's where the comparables are going to get tough. And that's the risk for 2026.
Yeah, I agree.
Is the comparables.
Yeah, the comps, yeah.
Yep.
So just finishing this piece on the equal weight, it's kind of like a 2-for-1 here. Is another post on 225 from the Trading Initiative, and he pointed out that it was the second day in a row where the SPY, or the S&P 500, closed down, while the RSP, which is an ETF for the equal weight, closed up. And he said, the the Mag 7 stocks have underperformed a little bit, especially Tesla. But there's 493 other ones that are hanging in there. These divergences often lead to buying opportunities if the market recorrects higher. So again, going back to the point that you made, where it's, someday just buying the S&P 500 might not work as well as it has maybe over the past, pick a certain period.
5 years, 10 years, 15 years.
Sure.
Yeah. I think that's a good way of saying it, Nick.
But
it might still work, but not work as good as it has.
Right. And the equal weight. So we're seeing some breadth in the market, right? So, and the market, for all intents and purposes, is pretty much flat where we are today. I mean,
Sure.
We're down 1%, but other areas of the market are perking up. So, I don't think it's all doom and gloom, and I'm not super worried about the premium valuations. And yes, a couple of the Mag 7 stocks have high valuations, but there's a reason, or premium valuations.
Yeah.
There's a reason, right?
Yep.
And they're still growing. NVIDIA is a perfect example. NVIDIA comes out this morning.
It's not a recommendation for or against the name, but just look at the growth rate over the last couple of years.
Right. And they have premium valuation, but they come out last night and earnings are good. So, the market's bidding a little higher. I haven't checked it since we've been on the podcast here, but
Their gross margins went from 74% to 72%, something like that. It's like those are gross margins that most companies would just salivate over.
Yeah, that's an insane gross margin. So
this is a good podcast today.
That's everything. Yeah,
this is a good podcast. We went long.
Yeah, we did.
I had a couple rants.
Yeah,
had a couple laughs.
Yeah.
This was fun.
We got Matt fired up on a couple of things.
Oh my goodness gracious!
Lots of hot sauce and spicy takes for listeners today. So
yeah, I'm sure we'll get some feedback on this one. Yeah. So thank you everyone for listening to episode 289 of the Independent Advisors podcast. Myself, Nick, Jenna, Mark, Aaron, Taylor, we appreciate you listening, and we'll catch you next week for episode 290.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.